We've talked about before, looking at the market from that kind of that 2008, analog, procedure. We're just tracking right along with that right now. In fact, what's interesting is that Bob Farrell, who was one of the greatest, most revered technicians on Wall Street for many years and is widely respected, as basically 10 investment rules that, he says, look, all markets follow these 10 rules. You follow these 10 rules and you kind of survive. And, bull markets are more fun than bear markets. That's one of his rules. And that's true, obviously. Another one is, of course, when all experts agree, something else is bound to happen. And we've talked about that kind of contrarian nature of the markets right now as an example. The American Association of Individual Investors, their bearish sentiment is now at a new record for this year. So, we were talking about how negative sentiment was back at the June lows. We're even more negative than that now. So one of those rules that, he talks about in his thing is that bear markets have three phases to them. They have an initial down phase. They have a reflexive rally that, kind of sucks everybody back into the market. And then the market goes, that's when the bear market comes back. But it's such a good analogy for kind of how bear markets work, because they're fast, they're brutal. They suck you back in, and just when you think kind of it's all clear in the water, it comes back, charging back again and just mauls you again. And that's what's going on right now in the markets. Is we're now, looks like we're now clearly entering that third phase of the bear market. Now, where's the bottom going to be? That's going to be the big question that we're going to be working through over the course of the next few weeks.
If we are indeed in a bear market, and you mentioned that it is tracking like a classic bear market so far, then this probably likely ends with people just being completely disgusted with stocks and not wanting to touch them. So we're now sort of on, capitulation watch. And my guess is we're probably still nowhere near there yet. This latest ravaging by the bear is still ongoing and still pretty fresh. But we'll talk about maybe the signs that we'll look for when we think that capitulation is happening. Before we get there, though, let's talk about some things that happened this week. The Fed hiked another 75 basis points. Right. So that was the big news of this week, probably adding to this week's momentum to the downside, building off of last week's as well, where people are really waking up to the fact that, yep, this is indeed happening, the pivot dreams we had. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The committee decided to raise the target range for the federal fund rates to 3 to 3.25%, and anticipates that ongoing increases in the target range will be appropriate, meaning, hey, we're going higher still from here, folks. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. So basically, QT is definitely going to continue, folks. The committee is strongly committed to returning inflation to its 2% objective. We're still at 8.3% CPI, so they got a long way to go. This is basically the Fed saying, look, folks, this is not going to be over anytime soon. Now, Powell himself said the following. He said, slower growth and higher unemployment, quote, are all painful for the public that we serve, but they are not as painful as failing to restore price stability and having to come back and do it down the road again. The Fed has now entered the danger zone in terms of the rate shock they are throwing onto the US economy. We've talked about how the pace of rate hikes right now are the fastest they've been in the history of the Federal Reserve's monetary policy.
There's a huge difference between the 1970s and today. And, back in the 1970s, the reason that we had, surging rates of inflation is because you had surging rates of economic growth. We were 80% of our economy was manufacturing, not 20%. Household debt to income ratios were roughly around 60%, not 150%. We were a blue collar manufacturing society. So economic growth was very strong. In fact, during the entire 60s and 70s, economic growth was expanding. We went from 6% to 7% to 8% growth. Savings rates went from 6% to 7% to 8%. Inflation was tracking along. Interest rates were rising along with economic growth. And one of them is, and look, I'll tell you, Paul Volcker made a mistake. He should have never tried to kill inflation the way he tried to kill it. It was a one-off event that was occurred by the Iran oil embargo, but he set a precedent for monetary policy to start this whole 40-year long process of lowering interest rates to try to stimulate economic growth. And we changed, of course, Reagan made a mistake by deregulating the financial industry as well. And that was just another predatory environment for individuals. But now the problem is as Jerome Powell thinks, that we're back in the 1970s, and we're not. We have an artificial surge of inflation caused by $5 trillion worth of liquidity into a shutdown economy. So we had no ability to create supply, and you had a tremendous amount of artificial demand. That's going to unwind itself very quickly. I think people are going to be shocked just how quick inflation falls as we get into early 2023. And the problem for the Fed is they've hiked way past the point where they're not going to be able to unwind it fast enough to catch up. As we talked about last week, it's like this is going to be a big problem as we get to 2023. And Goldman Sachs today coming out and going, well, we're changing our mind a little bit. We might have a mild recession. It's not going to be a mild recession, folks. It's going to be a pretty bad one. And when the Bureau of Labor Statistics starts revising their employment data, we're going to see that employment's a hell of a lot worse than what the current headlines say. So again, since the whole Fed is focused on trailing economic data to make these policy decisions, when reality sets in, it's going to be a big mean reverting event for, Fed policy and then them trying to get back onto the right side of this. And it's going to be a race for the exits, in terms of the Fed trying to play catch up with where the economy is going to be to try to keep it out of a much deeper recession. Again, to your point, there's a interesting chart out by Charter. This is the fastest pace of rate hikes. We're just hiking rates faster than any other point in history. And if you look at the dates of those rate hikes, right? So when did we have these extremely aggressive rate hikes? 1984 through 1986. What happened in 87? 1993 to 1994. What happened in 1994? If you don't know, by the way, that was a big bond crisis. We had a big bond market crisis in 1994. 1998 to 2000. I don't have to remind you what happened in 2000. 2004 to 2006. Don't have to remind you what happened in 2008. 2015 to 2018. Of course, you had Brexit, the Euro crisis, and the Fed taper tantrum. So, every one of these points, and here's the point, is that every one of these previous rate hiking cycles ended in either a bear market, a financial event, or a credit event. And we're now hiking rates faster and farther than every other previous rate hike cycle to date, and not expecting some type of event to occur from this. Everybody's like, oh, it'll be a soft landing, it'll be fine. It's not going to be a soft landing. And I think that we're going to have to be dealing with the ramifications of another Fed policy error as we get into 2023.
Today's weak economy and really just kick its knees out from under it, right? And so to your point, CPI may come down way faster than many people think it could right now. And to a certain extent, not necessarily endorsing it, but to a certain extent, the Fed can say, hey, see, we got inflation down, right?
Yeah.
But you're going to say, oh my God, we did not mean to break things this much. Things are going in a really bad direction. Now we got to play catch up, in your words, and try to reverse course. That's going to be the pivot that everyone's talking about.
Jerome Powell's talking about this whole thing that they need to combat inflation. And he made an interesting comment the other day talking about a new normal post this environment. And what he's talking about is below trend economic growth. And what's important is that the linear growth trend of the economy from 1947 through 2007 ran at about 3.2% real. That's inflation adjusted. We were growing at a growth trend line of 3.2% annually in GDP growth, inflation adjusted again, from 1947 to 2007. The financial crisis broke that and dropped us to about a 2.2% trend growth. Now what we're talking about is a trend of growth below that lower level. In other words, we are stepping down the trend growth of the economy over time because of the Fed's actions.